Good morning and welcome to this Money Control live stream. It's a Friday morning and you're watching Opening Bell here on Money Control with me, Nandita Khemka. The setup is looking fairly okay when it comes to what the global indices are doing this morning. Strong gains coming in on the likes of Nikkei, Kospi, other markets as well. The GIFT Nifty was around the 26,000 mark, but at this moment, it has slipped below that level. It was hinting at a positive start for us, but right now it is trading mildly in the negative zone. Yesterday, we saw the fireworks continuing on the Lal Street for a 6th straight day. We clocked in the 26,000 level as well on the index, but in the second half, there was some bit of volatility that kicked in. We saw, the Nifty giving up most of its gains. In fact, just about managing to end in the positive zone. In fact, the Midcap index, I think, ended in the red territory as well. So, all that excitement that we saw at the start of the trading session kind of fizzled out towards the end of the session. Also, the fact that it was the weekly Sensex expiry, so some bit of volatility kicked in. Plus, after 6 days of strong rally, the bulls did take some bit of a breather. But this morning, we are hoping to resume the up move that we have seen and, may perhaps end the week as well on a positive note with a 7th straight day of gains. Let's hope that happens. But of course, all eyes will be on that 26,000 level as to whether or not we can, reclaim that and end above that level as well. Lots of stocks in focus today, the likes of Cipla that has, inked a deal with Eli Lilly. We'll talk about that. We'll also talk about defense stocks, given the fact that the Defense Acquisition Council has, approved proposals worth 79,000 crore rupees. This comes in addition to all the deals, big deals that some of these names like HEL, I beg your pardon, BEL and HEL have bagged in recent times. So yes, defense names will again hog the limelight today, and a lot of other stocks to watch out for as well. So we'll focus in on that over the next 1 hour, and of course we'll take up all your stock related queries. So keep them coming in. We'll get them addressed by our experts. But before we do all that, quickly take a look at the top stories at this hour. Wall Street ends higher driven by strength in technology stocks. Nasdaq gains over 200 points. Investors meanwhile are awaiting the September CPI report that is due later today. That would give some bit of clues as to what the Fed will do. Asian markets meanwhile open higher, tracking Wall Street gains. The GIFT Nifty was positive. In fact, it is above that 26,000 mark as we speak, but it is trading mildly in the negative zone. Crude prices surge after US announces sanctions on 2 major Russian oil companies. Meanwhile, gold prices rise 2%, snapping out of a 2-day fall as geopolitical tensions renew safe haven demand. And Commerce Minister Piyush Goyal says India is in dialogue with the US for a trade deal, adds that talks are progressing and a fair and equitable trade agreement is expected soon. Defence Ministry approves capital acquisition proposals worth around 79,000 crore rupees aimed at strengthening the operational capabilities of the Indian Army, Navy and Air Force. The tri-services will acquire new missile systems, high mobility vehicles, lightweight torpedoes among others. And pharma major Cipla signs an agreement with US-based Eli Lilly, acquiring the rights to distribute its blockbuster weight loss drug Mounjaro. The drug, which was launched in India in the month of March, will be sold by Cipla under a different brand name across the country. All right, recapping yesterday's market action then, we, as I said at the start of the show, we erased most of the gains. The Nifty slipped over 200 points from the day's high. Reliance, slipped 3% from highs, tracking news with respect to Russian oil import curbs by the US. In fact, US has sanctioned 2 major, Russian oil firms, in Rosneft and Luke Oil, so that weighed in on some of these oil and gas names, including the refiners like HPCL, BPCL, IOC. But IT was the one that was firing up, and of course it started the trade with gains of somewhere around 2.5%. At one point in time it was rallying in excess of 3%, but still managed to end higher by about 2% or thereabouts. In fact, the Nifty IT index hit a 1-month high as well in trade yesterday. Of course, crude sensitives like OMC's, airline stocks, they fell anywhere between 2 to 3%, because oil prices were surging. Even last night they surged somewhere around 5% or so. So keep an eye out for some of these oil names as well. Eternal was extending losses yesterday. That stock slipped somewhere around 3%. HUL reported numbers. The numbers were in line. The stock rallied 3% right after the results, but closed with minor gains, gave up most of the gains. Laurus Labs reported a beat in the second quarter. Good numbers, good commentary as well coming in. The stock was up 2%. And, I think this morning we have brokerage calls as well, wherein they have a buy call on the stock. But aside of that, if you look at some of the other cues, the option cues, the put call ratio fell to 0.95, below that level of 1 compared to 1.08 in the previous session. No stocks in the F&O ban today. Saman Capital was one stock that was in the ban list. It exits from the F&O ban today. And FIIs once again, I think, saw turn net sellers yesterday, but mind you, they have been buying as well, for a couple of sessions. In fact, the sell-off, most of the sell-off seems to have halted, but yesterday they were selling to the tune of 1100 crore rupees. DII net buying continues. 3,900 crore worth of equities were bought in the cash market. In terms of results to watch out for, Dr. Reddy's, SBI Life, Coforge, SBI Card, these are some of the counters to watch out for. And Midwest is the stock to watch out for as it lists on the exchanges at 10 a.m. today. Well, that was all about the cues to watch out for and a recap of yesterday's market action. But how does the setup look like for today? Are we poised to clock all-time highs in the next couple of sessions? Let's pose that question to Raja Venkatraman, co-founder at NeoTrader, who's joining in this Friday morning as always. Raja, lovely chatting with you. First of all, wish you a very, very happy Diwali, season's greetings. Hope you have a great year ahead, a profitable one, where you have health, wealth, peace of mind, everything. But in terms of market as well, we saw fireworks and the bulls picking up steam just at the right time. Yesterday, there was a bit of a breather in the second half, but does the chart indicate that we would see a resumption of the momentum that we have seen in the last few sessions and all-time high next week? Can you say that with certainty?
Yeah, good morning, Nandita. Thank you for inviting me to the show and wishing you and the entire team at Money Control a very happy Diwali and a prosperous new year ahead. Now, looking at the way the markets have behaved, it was very clear that the strong bullish run would extend, and it extended in a very profitable way for many of us out there. But then, like all good things must come to an end. Just like, the firecrackers also, they burst up and then the rocket eventually comes down. So what has happened yesterday is that we opened with a gap up, and the gap up witnessed some profit booking. So overall, the structure seems to be on a strong note. But then based on some kind of data analysis which I did over the last 15 samvats, I found that the 9 samvats out of those 15 have ended on the negative zone in 1 week to 10 days post the samvat. So this particular scenario which we are seeing right now, after the samvat, a big gap up, it was witnessed last in 2011. And after that, there had been a correction. So if that has to repeat, like they say in the market, history repeats. So if that has to repeat, then yesterday's low would assume a lot of importance. So considering the data, considering the pattern, and considering the way it has behaved in the past, and also based on certain time cycles projections, I feel that yesterday's low would be very critical. So I would not be extremely bullish at the moment. Yes, the scenario is bullish, but I would wait for a pullback to buy into rather than getting adventurous on breakouts. The market has run up very swiftly. It has taken everyone by surprise. And right now, the FIs are just covering their shorts in bits, in phases, you can say. But when they will come in full flow and go on the long side, that's when you will see the uptrend sustaining. So now the problem is that the uptrend is not sustaining. Even now, as the result season pan out and we digest the result season and then we come out with, how we move ahead, that's when the bullish momentum will sustain. So now the triggers for sustaining the bullish momentum are emerging, and I would wait for them to sustain before I say that the all-time high will be surpassed in the next week. Yes, the all-time high is going to be surpassed, and that's going to happen in this quarter. That's what is the overall setup looking like. But then I would pause to comment on that front, and I would wait for the market to give a pullback. And the pullback zone which I am expecting is closer towards the region of around 25,700 to 800. Even the option data is suggesting a similar front. So I would say that a pullback should not be missed, and those who are index traders especially should track Nifty and use those levels to buy into.
All right, buy on dips and avoid being adventurous at at these higher levels. That's the call. But just about 2 minutes to go for the markets to open. What would you be looking at buying or selling at these levels? Any recommendations?
Yeah, I would like to go with a sell because, according to me, that's a safer bet for the moment. So I would like to go with a sell in Dalmia Bharat because even after the result, the stock has not really shown much traction here. So I would like to sell it at the current levels and wait for stop loss above the around a 2% stop loss I would like to keep, and for a target towards 2070. So a stop loss at 2165 and a target of 2070 is my target. And a sell in eternal, like you mentioned, the results have not been digested well this time, and it is witnessing a sell off. And yesterday the sell off was quite aggressive. I think that the sell off could extend. So sell it at the current levels with a stop at 335 for a target towards 320.
All right, those are the recommendations from Raja. But Raja, just about I think less than a minute to go for the markets to open. Let's discuss the Nifty Bank Index as well. Of course, it did hit a fresh high. It has been consistently hitting fresh highs, but came off significantly from the highs yesterday. Would you consider 58,000 as a floor?
Yeah, definitely the way the indices are moving, I would say that yes, for both the Nifty as well as Bank Nifty, I would continue to maintain the same stance of marking yesterday's low as an important trajectory in the days ahead. So if that were to happen, I would not cast away my bullish aspirations, but I would definitely step back, wait for the decline to settle down, and then resume the bullish activities. Because I would stay on the bullish side, but definitely not trade on the breakout.
All right, not trading on the breakout when it comes to the Bank Nifty as well. Buy on dips, that's the call. But let's take a look at the market, take stock of how the markets have opened. We did open with a green tick, but right now we are mildly lower, no big moves, subdued kind of a scenario right now when it comes to the market. Taking a look at the mid-cap index then, that's kind of managing to just about clutch on to the positive territory. So yes, it has been a quiet start for the market, so to say. 25,900 has been taken out on the downside, and the breadth right now is skewed in favor of gainers. Unlike yesterday, when the breadth was strong, we started on a very strong note, but towards the end of the session, the advanced decline ratio flipped, and we saw it favoring the laggards. Today, as of now, it is in favor of gainers, but let's see, let's wait for things to settle down and see whether or not this can sustain or not. Bank Nifty as well has slipped into the red, but it is holding on to that 58,000 level. And as we speak, the mid-cap index has also slipped into the red. So yes, a quietish start. For now, we have snapped out of a 6-day up move, but let's really see how things really pan out going into the full day. But take a look at the other sectoral movers then. IT is extending its gains. It's up another 0.5%, but it's the metal pack that's leading from the front. And there is a trigger. Aluminium prices on the LME have rallied to a 52-week high, which is why I think some of these names, aluminium giants like Hindalco and Alco, should be among the top gainers today. Yes, Hindalco is the top Nifty gainer as we speak. It's up almost 3%. Want to see what Nalco is doing as well. That stock should also come up on your screen. Yes, Nalco is also up 3% or so. So yes, metal names hogging the limelight today. In terms of the other movers then, ICICI Bank, that has been a laggard in recent times, has managed to edge back into the green. That's up almost 1%. ONGC, Shriram Finance, by the way, has been doing well too, extending gains. M&M Trend, Bharti Airtel, Jio Finance, HDFC Bank and JSW Steel, Ultratech Cement, these are among the other gainers. On the flip side, HUL, that's down 3%. We'll take stock of what the brokerages have made out of the numbers. Of course, volumes were flat, and there were not really any fireworks in the numbers, but management did say that they will be looking at volume driven growth going forward, and that the second half of the current financial year will be much better than the first half. So commentary wise, things were okay, but it's the postponement of purchases post the GST reform announcement that kind of weighed in, and of course also the GST related adjustments that kind of weighed in on the quarter. That was largely expected, but we'll take stock of what the street is really making out of the numbers, because that stock is down 2%, almost 3%. Cipla, that's the other news maker. It has inked a deal with Eli Lilly to sell its weight loss drug in India, but that stock is down 3%. Of course, we will figure out as to, we'll see what analysts have to say about this deal, because that seems to be weighing in on sentiment for Cipla. Aside of that, you have Kotak Mahindra Bank. Dr. Reddy's ahead of numbers is under pressure. Axis Bank is also down. So is Eternal extending its losses. Adani Ports, that's also a laggard, and so is Tech Mahindra, although I think the IT pack was holding out in the green. Tech Mahindra seems to be bucking that trend. Yes, IT pack now extremely flat, but still it's trading in the green. But let's talk about a Cipla. Raja, there has been a deal. Analysts believe that the weight loss drug could add somewhere around 3% to its domestic revenue and 1.5% to EBITDA in the next 3 years. And this also means that Cipla, which is more attuned to the respiratory side, has diversified itself and is looking to sell a weight loss drug in India as well. But Cipla, Dr. Reddy's, any thoughts? What would you do with this stock? The stock is down 3% post this news flow.
Yeah, so the news flow is definitely on the positive side, but what you are seeing right now is a reaction based on the current market scenario, and the rise which we have seen in Cipla over the last month has been quite prolific. Almost a 200-point rise from the lows was clearly a bonus as far as Cipla is concerned, because normally the stock tends to move in range. So probably the news had already been factored in, and we are now witnessing a reaction right now. But the reaction right now are levels to buy into. So I would say that amongst the stocks that are moving and the sector per se, pharma is definitely a much better sector. It has been able to give out certain positive names like Dr. Reddy is also a good stock, Apollo Hospital, Fortis. So I would say that Cipla, Dr. Reddy, Fortis, Apollo Hospital, these names are definitely on the trended side, and any reactions are considered to be an opportunity to buy into. So the reaction which you are seeing in Cipla today is an opportunity to buy into.
Okay, the reaction on Cipla is an opportunity to buy into. The other pharma name that's been in focus is Laurus Labs. Numbers were pretty good yesterday. Management commentary is also looking upbeat. The stock was up somewhere around 2% or so, but looks like it has succumbed to some bit of a profit taking. I think it came very close to its 52-week highs today as well. 944, that's a 52-week high, and it the session high today was 943. The company has said that revenue drivers would be the continued robust CDMO industry outlook. Underlying margin is also expected to be higher going forward. In fact, a stable business is also something that could aid growth going forward in terms of entirely how the CDMO landscape is panning out. At these levels, how do you find the risk reward for a Laurus Labs? I think in the last 1 month, the stock hasn't really been, hasn't really given any blockbuster kind of a return, but it is still close to its 52-week highs. At this level, risk reward wise, how is the stock looking?
Yeah, the stock has been attempting to move up, but then ever since July, the 930 to 950 band has become a very, it's like a bottleneck for the counter. So I would say that again at this juncture, crossing those levels is paramount. But then considering the nature of the market, any reaction towards the region of around 875 will be a more comfortable area to buy into, because the stock is definitely making a base around that region, so closer towards 875 to 885. And I would say that that can be a good support to buy into. So buy on support is my call on Loris Labs.
Okay, that's about Loris Labs. But let's shift focus to Federal Bank. Because the board of a federal bank has approved issuance of warrants to Blackstone. Now, Federal Bank will issue warrants worth 6,200 crore rupees almost to Blackstone at 227 rupees per share. Blackstone will get the right to nominate one non-executive director once it has sold, once it in fact holds 5% stake. So, we had recently heard from RBL Bank as well, and Yes Bank as well had a deal, and Federal Bank had already indicated that it is raising funds, and now this has come through. How are you approaching these three counters now?
Yeah, so talking about Federal Bank, we can see that the Blackstone associate who has taken a 10% stake, that's definitely encouraging news because big name is investing into the bank. So that has given it a good leg up, and I can see that the stock should go up further. And this stock has run away in the last 2 to 3 days. So again, we can see some bit of news getting factored in. But I would say that the stock continues to hold promise, and any pullback to the region of 220. So today, I would advocate all the viewers to buy on pullback, because the market is not in a breakout stage at the current juncture. And the pullback, which I would say in a Federal Bank, would be closer to the region of 220 to 225. So this overall setup is good. It's positive, but then
Okay.
I would say that instead of buying at right at the top, buy it on a pullback.
Okay, buy it on a pullback. That's the call on a Federal Bank. But let's shift focus to viewer queries then. Quite a few of them are trickling in. Although there are quite a few stocks that I also want to discuss, but let's get to the viewer queries then. Since we are talking about banks, there's a query on SBI. I think I just spotted it. I think somebody wanted to know as to whether one should look at a fresh entry in SBI for the next 6 months to 1 year. This query is coming in from Komal Makecha. How would you look at an SBI at these levels? Is it a good bet for a fresh entry with a 6 month to 1 year time horizon?
Yeah, SBI definitely is one of my favorite PSU counters. I keep reiterating in our shows, Can Bank, Bank of Baroda, and even Indian Bank is another good bet which I've added to this list. Now, SBI, it has moved quite sharply, and I would say that buying at this juncture would not be appropriate. So wait for some reaction closer towards the 890 to 880 region, and that will be a good area, because you can have a risk zone at 860 and target for some upward trajectory, and upward trajectory is possible towards 950 within the next 6 months.
Okay, 950 within the next few months is possible on the charts of an SBI. Next query, I didn't really get this gentleman's name. It's CK Sat or something. Wants to know, he holds transformers and rectifiers since the last few months at 500 rupees. Wants to know whether switching to Voltamp is a better bet for the next 13 to 18 months. And there as well, he wants to know the target.
Okay, so first of all, transformers and rectifiers, they have not moved anywhere in the last 9 months. And even in the higher time frame, they don't show any keen interest to move. So it's slowly the grip of the bullish bias is slipping. So in comparison, Voltamp has been a much better performer. So now I would say that if you want to get into Voltamp, there is some bit of recovery being seen here. So if you want to switch, then the timing is right now because Voltamp is getting into the act, and I would say a target towards 10,470 is possible in Voltamp.
Okay, that's the target to watch out for on a Voltamp. Hope that answers your query. There is a query on JSW Steel as well from Asad Munib, and he wants to know, the outlook on a JSW Steel. We've seen the aluminium giants doing well today. Of course, aluminium prices on the LME have hit a fresh 52-week high. The likes of Nalco and Dalco rallying in excess of 3%. But steel makers have also been doing well in recent past. At a time when the markets weren't going anywhere, we saw good traction in the entire metal universe. Where are you in terms of ferrous and non-ferrous? Would you look at some of these steel names like JSW Steel, Tata Steel, or would you prefer the likes of Nalco, Hindalco, the aluminium makers?
Yeah, so I would say that JSW Steel, Jindal Steel, they have got more traction, more patronage, and the movement is there quite a bit. From that, I like Jindal Stainless because that seems to be holding on quite well. So if you're looking to participate in the metal move, like the metal index is also giving a multi-month move here. So I would say that if you want to participate on the metal names, my pick would be Jindal Stainless. It has got good potential here, and you can also consider it as a long-term bet, and you can participate for the next few months and have a target towards 1200, which is very much possible in this counter.
Okay, that's the view then. Hope that answers your query. There's a query on Sequent Scientific as well, just getting it addressed then. Harshal Mistry wants to know what to do with the Sequent Scientific. He's been stuck on this stock for a long time. If you've seen the charts of Sequent Scientific, any thoughts? How should one really navigate their existing positions?
Yeah, considering the stock is a pharma counter and the pharma sector itself is showing some bullishness here. So overall, the stock seems poised for upside. Yes, it's a slow mover. So one should factor that in their overall trajectory. And yes, it's showing some positivity to the upside. A target towards the 250 is possible within the next 6 months.
Target towards 250 possible in the next 6 months. But what are you doing with HUL after numbers? The stock is, not really in favor today. In fact, it has slumped to the day's low, 3.5 to 4% cut on an HUL post numbers. What was the positioning like for you ahead of numbers, and what would you do with the stock now?
Yeah, the last time the numbers they reacted well, and this time it's the other way around. And probably the GST rate cuts, the consumption theme, the festive theme, they're all getting factored in right now. So, like how in the markets always positive news gets factored in earlier. So that's what is the scenario looking like. So I would say that HUL has never been in action. So amongst the FMCG, HUL or even Marico or even ITC, they don't, if you're participating term or the term for which you want to hold is a short term, then never consider these stocks. These are stocks which you have, if you have the temperament is not existing anymore, have a range of 3 to 4 years, then you can go ahead and put money in such stocks. Otherwise, it's better to look at some better counters. So I would say that amongst the FMCG pack, Nestle is a better bet. The quick commerce space is a better bet. So amongst that, if you want to go in with an Nykaa, so the new age ones are a better bet than going for the older giants because they don't seem to be moving in the way the current temperament is right now. So it's advisable that HUL it's more of a trading zone than a kind of an investing zone.
All right, that's the view on HUL, and of course, Nestle is the preferred pick from the FMCG basket. With that, we've come to the end of the query segment for today. If you couldn't take up your queries, please don't worry, keep them coming in, send them in on Monday, we will get them addressed. But Raja, I would like to thank you on that note for taking our time and joining in and sharing your thoughts with us, helping our viewers navigate their holdings as well. And I look forward to interacting again next week.
Thank you. Good day.
Thank you. That note, take a quick look at the market. We are where we were at last time I did a market check, extremely flat but trading with a negative bias. For now, we've snapped out of a 6-day gaining streak. Let's see whether we could gain some momentum as we go along the day. The Midcap index, however, has managed to come back into the positive zone. It's in fact now trading with gains of 0.3%, and the breadth is even Stevens, slightly tilted in favor of gainers. So overall, the texture of the market is fairly muted right now, but let's see how things really pan out. IT was extending gains, but it was the metal pack that was among the big movers this morning. But let's bring on board a big market voice joining in to share his thoughts and, of course, tell us what's in store for the market here on. Joining me is Alok Agarwal, who's head Quant and Fund Manager at Alchemy Capital. Lovely chatting with you, Alok. First of all, wish you a very, very happy Diwali, season's greetings, and a great Summer 2082 going forward.
Yeah, happy Diwali to you and all your viewers as well. Pleasure being here.
Thanks a lot. Let's talk about the market then. Over the last 1 year or so, we've seen the market really test our patience, right? It really went nowhere, no big returns, and especially for investors who had gotten used to 20 to 25% kind of returns. Extremely flat, but now that the bulls are back, they started picking up traction at the right time, and in fact, we came very close to the all-time highs as well. What's your gut feeling? Do you think this leg of the up move that we have seen over the last 2-3 weeks is sustainable? And have we climbed all the walls of worry, given the fact that signs of thaw are also emerging when it comes to the India-US trade deal?
Yeah, Nandita, hi. You actually rightly pointed out what's happened in the last 1 year. Like it's been a major time correction. In fact, a lot of price correction in the broader markets as well. As we see the start of the year as well, last 4 years after the COVID was so good, the markets and the earnings really compounded at a very good pace. But a lot of things changed after the Lok Sabha elections last year. And from capex driven expenditure, we started moving towards subsidies. There was a lot of tightening on the fiscal side. There was a lot of tightening on the monetary side as well. And at the same time, the monetary tightening was at the cost of maintaining the rupee. So a lot of these decisions went against the overall economic growth. And we found that suddenly the nominal GDP growth itself also came down. We had multiple months of GST collections being in single digit growth itself. So those things had a big impact. And those numbers came at a time when the valuations of India were also pretty high. These things have got corrected largely over the last 1 year. In the last 1 year, while our markets are flattish, the global markets have really rallied. India has underperformed the world markets as well as the emerging markets by over 20% in last 1 year, which is a kind of a record number in the last 15-20 years. And a lot of corrections have happened. So in terms of quality of expenditure also, from monetary tightening, we have come to liquidity easing. The CRRs have been cut, the interest rates have been cut, the system liquidity from deficit has turned into surplus. The earnings cut cycle is also almost like behind us. We are looking up towards the earnings growth also. So those numbers have started coming back in a much, much better way. As you rightly pointed that phrase, a wall of worry, it seems like we have more or less climbed that wall of worry. And it's just like the risk reward has started turning very attractive now. There are pockets of growth available at reasonable premiums as well. So that would be the view. Like we are positive, selectively positive on the segments that are offering visibility of growth.
Okay, before I come to those sectors that are offering visibility of growth, let's talk about foreign fund flows as well. They have been big sellers this year, right? But of late, the selling seems to have abated a bit. Do you expect a meaningful pickup in FII flows here on, given the fact that you also mentioned that earnings have started to show green shoots, and we've seen that playing out in IT as well. We had fairly muted expectations. On the basis of that, numbers have been fairly okay, and banks have also been good. So, in terms of FII flows, do you expect them to return, given the valuation comfort it offers vis-a-vis other emerging markets, and of course also the fact that earnings are showing green shoot. Do you expect a meaningful recovery, and which are the sectors that could be poised to see the most part of inflows, and one should position them before the influx?
So absolutely, certainly, we expect that the FI flows to start turning positive very soon. The last few days is just one of the recent examples. But we need to understand, a year ago, when the majority of the outflow started, they found a market which was high on valuation. They found a currency which was overvalued, and they found a market which was like kind of going to see a downgrade in terms of earnings growth. So that was kind of a Goldilocks situation for somebody to exit. But those things have started turning completely upside down. So now FI's holding in India is at a multi-year low. The valuation premium of India versus the world as well as versus emerging markets has come down. Versus emerging market is at a 10-year average, the premium, and the premium versus the world is actually below the 10-year average. So the valuation excess that was there, that has largely been cut down. The earnings growth cycle has been improving. The quality of expenditure has improved. The RBI, the central banker, has been very, very supportive of growth with liquidity measures, right from the system liquidity to the rates. So a lot of those things have started turning around at a time when their holding, our FI holding in India is at a multi-year low. All this comes also at a time when India has majorly underperformed the emerging markets and world markets. The FI underweight in India currently is at the lowest, is at the highest level, highest underweight that they have since 2009. So all these things look like it's poised for those numbers to come back. They also have a lot of shorts in the index futures, etc. Possibly it could be that first covering of those shorts, and thereafter you might see more buying on the cash levels. But on the whole, we see risk rewards improving massively, and I'm sure the FI is also taking note of the same. Possibly trade deal kind of events could be a catalyst in that movement. But nevertheless, the risk rewards improving, FIs would be kind of compelled to look at increasing their India allocations.
Okay, and which other sectors would you see IT and banks to be the big sectors where the bulk of the money flows? And should investors look at taking positions? A, because bank numbers of course have been fairly good, and even in terms of IT, numbers have been fairly okay with respect to low expectations, but valuations wise IT of course has corrected quite a bit. So are these the two sectors where one should get in right now?
In fact, both the sectors haven't done too well in the last couple of years. But as it is, India is a growth market, and growth is the area that FIs or any the institutional investor would want to go forward for. IT doesn't really promise, especially the large cap IT, they don't really promise of very high growth or at least substantially above the nominal GDP growth. So that's why our view on IT is very limitedly positive into those smaller companies which are offering higher growth. But in terms of banks and the financials, the whole gamut, right from banks to NBFCs to the capital markets are already doing pretty well. The banks and NBFCs are showing signs of bottoming out. We need to understand that the credit growth and deposit growth in the system is standing at around 10%. Once we start seeing those pick up, especially possibly once we start seeing the impact of the GST cut numbers also on the finances, I'm pretty sure that those numbers are looking like bottoming out. A lot of steps have been taken by the RBI in terms of easing the lending rules also. A year ago, there was a lot of barriers put on lending for unsecured loans. Now those are easier. Now the banks can also participate in the M&A. So right from the unsecured loans, smaller ticket items to the large ticket items like participation in M&As, a lot of lending rules have also become easier. All this coming at a time when the growth numbers on the credit growth as well as the deposit growth has not been that great. So I would say banks and NBFCs and the whole financials look far better placed. On IT, our view is not very positive.
All right, got your point. In terms of banks as well, if we break it down between private and PSU banks, what would the preference be? Because in terms of PSU banks, if the government, of course, is considering higher FIR limits and valuations wise, they are better poised vis-a-vis private peers, and margins wise as well, we've seen the performance is much better. So tactically, would you look at PSU banks vis-a-vis private banks?
So it's been a rare occasion where both PSU banks and private banks look good. Typically, it has been a choice between the two, and more often than not in history, the private banks have won the race. As of now, both private banks and PSU banks offer good risk-reward opportunities. But purely from a delta perspective, purely from a percentage return perspective, PSU banks are better placed. Most of these leading PSU banks, their net interest margins are at a multi-year high, their ROAs are at a multi-year high, and in fact, very interestingly, the credit cost of PSU banks as a cohort is almost comparable to the credit cost of private banks as a cohort, which has usually not happened. Typically, the credit costs of PSU banks have always been higher. So those numbers are pretty much in favor of the PSU banks as well. So we are positive on both, but we see a higher percentage gain possibility in PSU banks as of now.
Okay, got your point. Higher possibility of gains in PSU banks. But let's talk about the government's consumption kicker as well. How are you looking at consumption as a space? And I'm talking about it because, of course, HUL reported numbers yesterday, and the impact of delayed purchases and GST-related adjustments was clearly visible in the numbers. Although the management said that the second half of the year will be much better compared to the first half. When do you really expect the actual demand to reflect in earnings? Would you expect that from this quarter itself, or would you say that we will have to wait for a couple of more quarters before it really shows up in the numbers of FMCG companies?
So within the consumption basket, we are not very positive on the FMCG side. We are more positive on the discretionary side. A lot of these FMCG companies, if you notice, even if you look at their operating income or the EBITDA, for the last 3 to 4 years, their EBITDA has been in a very narrow band. So for companies that are trading at maybe 40 times, 50 times a year ahead, if they grow at a pace which is substantially below even the nominal GDP growth, the growth versus valuation metric doesn't really work or doesn't really provide great risk reward opportunities. But the same is not true for discretionary. The discretionary side, some of them are trading at a higher valuation, but the growth numbers are also pretty good. And in both these spaces, we also have a lot of platform companies emerging who are taking a nice pool of revenues as well as great share of the pool of profits as well. So those platform companies also we are very positive. Some may want to classify it as tech, some may want to classify it consumption, but we do see that as a good delivery of consumption related goods there. So we are positive on consumer discretionary, both goods and services, as well as the platform companies. Within consumer discretionary as well, barring especially those watches, jewelry, as well as cars, etc. Even other items like consumer discretionary services also includes the travel side, also includes the saving side. So that's why the capital market plays are both the financial plays as well as consumer discretionary savings plays. And the travel side, be it the aviation or the hotels or the platform companies there as well, we are quite positive on them, and some of them are actually showing pretty good growth as well.
So, okay, that was on the consumption side. But what about defense manufacturing itself? We've seen a lot of clearances coming through from the Defense Acquisition Council or the likes of PSU names like HAL, BEL, or winning large orders. But where are you in terms of valuations when it comes to these names? Because they have already seen a fair bit of run up, and some experts have also pointed out that the next 5 years of growth may already be in the price. Would you concur with that view, or would you say that there could be still some room as more and more of these orders trickle in? And which end of the defense pack would you look at? There are some private names, smaller names as well. Do you see more room for growth there? How are you looking at the entire defense universe?
So let me break it up into the near term as well as the longer term. So near term, you also spoke about manufacturing, industrials, and defense. So, if you look at this year, start of the year through the budget, the government had given the bonanza in terms of direct tax cuts. From September, they gave the benefit of indirect tax cuts also. So a lot of boost coming from that side. So in a slowing economy, the economy has not grown at a great pace. In such a case, they need to balance out their expenditure as well. So either they continue with the capex and ensure that the fiscal deficit expands a bit, or they continue to go for fiscal consolidation, wherein the capex can take a slight hit. So far, they are maintaining their targets. Within the capex, two areas where it is very, very difficult to cut expenditure are defense and power. Both of them, they require their expenditure. If at all any capex cut has to happen, it has to happen in areas other than this. So that's why we are seeing this constant recurrence of defense orders being given. As far as defense is concerned, the geopolitical world in which we live now is very, very different from what it was maybe 5, 10, 15 years ago. Today, the expenditure of defense as a percentage of GDP that has been rising globally. Just to give you context, broadly speaking, the global GDP is around $100 trillion, and all countries put together, they spend somewhere around 2.5 to 2.7% of GDP as defense. We have seen in recent past that the US umbrella for even the NATO countries for security provision that has actually come off. All these countries have started increasing their own defense expenditure as well. India is uniquely positioned with not so friendly neighbors. We need to also ensure ensure that our own capabilities of defense goes up. A lot of import substitution has already happened. Just to give you the context, if the defense expenditure in the world today is around 2.5% of GDP, during the Cold War times, it was 6% of GDP. So we do expect that these numbers of defense allocation as a percentage of GDP to rise globally. It's happening at a time when India is, instead of importing, is producing a lot locally. And especially in some of these Operation Sindoor oriented fights itself, we showed some of our capabilities of this production as well. And some of the areas we'll be able to export to. So for me, or the way we look at defense is a multi-year opportunity. It could be a multi-decade opportunity as well. We almost link it to the kind of auto sector in the 1990s. The sector has just opened up. Today, we see predominantly the larger assembly guys, the larger guys who are taking the orders, which are behaving like OEMs. As the sector starts seeing more and more visibility, we will be seeing a lot more vendors, lot more ancillaries coming up. So we are positive on the overall sector. There would be volatility, but we would be buyers on dips there. The longer term visibility is pretty good, and the focus of the government is right there.
All right, a multi-decade opportunity, that's defense, and buying on dip should be the strategy. But there's been a lot in terms of, Russian oil purchases as well. And now we've had the Trump administration slapping sanctions on two major Russian oil firms as well, Rosneft and Lukoil. Just want to understand, your thoughts on oil PSUs in the wake of this. Of course, this also impacts margins, refining margins for the likes of IOC, HP, BP. Have you looked at this, and how are you approaching the entire oil basket in this light?
So there has been a lot of sound bites over the last few days regarding whether India would continue its purchases from Russia or not. Obviously, all of us as market participants are also waiting for the trade deal to happen. And one of the major roadblocks for that is India's purchase of oil from Russia. Going by what the statements keep coming from the media side, it seems like that there has been some talks as well. And but we need to wait out for the real announcements as to whether India has promised it will cut down on the Russian oil purchases or not, and what is the actual tariff number that we're looking at. Coming to the sector itself, you mentioned about the OMCs. Typically, these OMCs, they have a great business model in general, and the valuations are not too expensive. It is just that the visibility of their margins, the ability to pass on the prices, that all depends upon what the government positioning also is. So that actually inhibits us to really give the good visibility of growth for such companies. And in case of any untoward movement of the crude prices or maybe an impending election, a lot of times I've seen that their margins take a hit. That actually stops us from taking a very good overweight or high position in such companies, and we actually kind of avoid that sector and maintain an underweight stance.
All right, underweight on OMCs. Since you mentioned that, of course, there are media reports suggesting that the actual tariff rate may be much lower than the 50%. The recent report stated it could come as low, it could be as low as 15% as well. Something like that, would you say that that's not priced in and that could ignite a fresh leg of rally in the Indian market? In terms of what's digested in the market, would you say that a much lower rate has already been factored in, given the kind of up move we've seen in the recent weeks?
In fact, the majority of the underperformance India had in the last 1 year versus the global markets actually came in the last 3-4 months. The major part of that came in the 3-4 months after the announcement of this 50% tariff. So I wouldn't really say that market is really expecting or already discounting any kind of major cut in those tariffs. But it's quite speculative to say that what would be the final tariff. The numbers, as we understand, the number was 25 plus 25. That is, the additional 25 was for Russian oil purchases.
Yes.
So in case the deal breaker was whether the India continues with Russian oil purchases or not. If they don't continue with purchase or slowly bring it down, from 50 to 25 looks like an easier task. But the question at the media articles, the speculation is all about whether we settle at 15-16% or we settle at 20 or we settle at 25. This is anybody's guess. But broadly, as we see, the key allies of US who have been natural allies like Japan, Korea, UK, those have been inflected with rates of 15%. Majority of the Asian economies, which are more comparable to us, they are in the zone of 18-20%. So the likelihood of those final number being closer to 18-20 is much more than being closer to 15. But again, this is just numbers as they stand. Any kind of guesswork, any kind of estimate would be like speculative. But it's just our understanding as to where others peer sets are standing. We would await the announcement to see where the trade deal actually gets signed. But yes, once the trade deal gets signed, that would be meaningfully positive for the markets.
Sure. Of course, it will be speculative, 18 to 20%. But if that is the final level, would you still say that it's discounted, or would you say that that would open up another door for a big rally in terms of the market expectation?
It's for big rally. So I don't see that being majorly discounted in the markets. There is a lot of nervousness around it. So I don't see that being discounted.
Okay, that's not being discounted. Got your point. But the final few questions, I have a whole lot of them, but I'll just restrict myself to two more. In terms of finding alpha, which are the top two sectors that you foresee giving good returns over the next 1 to 2 years?
So if I would go for capital markets and platform-oriented companies.
All right. Platform-oriented companies and capital markets. And which are the sectors that are complete avoids at the current juncture? I think one you said was oil PSUs. But aside of that, any other sector which you feel is overhyped, or perhaps valuations are too expensive there and doesn't really match up? Anything that comes to your mind when you say that this is something that should not be part of portfolios?
It's predominantly FMCG and large cap IT.
All right, FMCG and large cap IT. All right, that's the view then. With that, Alok, would like to thank you for taking out time and joining in. A good conversation, and I hope to have more of that in future. I'll save all my other questions, other sector related questions for that time, but appreciate you joining in this morning. Lovely chatting.
Thank you, Sam. Yeah, thank you.
Thank you. Thanks a lot. Well, on that note, we are coming to the end of this edition of Opening Bell, but let's see what the markets are doing. All right, nothing much has changed. We are still around that 25,880 level on the index, but the mid-cap index has picked up some steam. It's now up almost 0.4%, but the rest of the market is looking extremely muted. The advanced decline ratio, in favor of gainers at the juncture, but it's largely even Stevens, and it's the metal index that's really leading from the front today, all thanks to a rally in the prices of aluminium on the LME. That's hit a fresh 52-week high, and that's providing support to stocks like Hindalco, Nalco, etc. The Nifty Metal Index, in fact, is now gaining almost 2%. Real estate index as well, that was upbeat yesterday, is extending its gains up 0.7%. IT is showing strength at the current juncture, up almost 0.5%. But sectors that are not doing all that well are the likes of FMCG. FMCG, of course, is down 1.5%, and that's largely due to the reaction that we are seeing on an HUL. That stock was the top Nifty laggard. That's down somewhere around 4%. And even Cipla, after that deal with Eli Lilly, that stock is down 2.5 to 3%. But Raja was saying that most of that may already have been priced in, which is why we are seeing some bit of profit taking on a Cipla. But with that timed out on this edition of Opening Bell, thank you for taking out time and joining in and watching us and being with us. Be with us for the rest of the day as well. Log on to moneycontrol.com for all your other news and updates, and of course come back and join in at 3 p.m. once again on Closing Bell with me. I'll see you then. But till then, have a great trading day. Thanks for watching.